another powerhouse in the mutual fund business, getting into the ETF business. Let's talk to Holly Framstead. She's the director of ETFs for Capital Group, which owns the American funds, and my old friend Dave Noddick from ETF Trends. Holly, Capital Group set to launch its first 6 ETFs tomorrow, all of them actively managed, all launched down here at the New York Stock Exchange. Capital Group's a relatively latecomer to the ETF space. Can you tell us why now?
Yeah, thank you so much, Bob. And I actually believe our time in market is just perfect. We don't launch funds very often. And when we think about bringing a new ETF or a new vehicle to market, it's really about listening to our clients and understanding if we can deliver on their expectations in the vehicles that they're asking of us. Recent regulatory change has meant that we now believe we are positioned to package Capital Group's time-tested, actively managed strategies in the ETF vehicle. And so when we think about the products that we'll be listing on the New York Stock Exchange tomorrow, we'll be bringing 6 funds to market that really fit a majority of the major asset allocation building blocks. They're designed to sit squarely at the core of a client portfolio and ultimately simplify the investment process for countless financial advisors and end investors.
You know, when I look at these, they're very much like actively managed mutual funds that you already run, but not quite. There's a little bit of difference. There's 3 equity strategies that invest primarily in the U.S. You've got 2 equity strategies that cover international and global, and you've got a fixed income core plus strategy. But they're a little bit different than the mutual funds. How are they different? And why don't you just clone them into the ETF space like some other mutual fund providers already have?
Yeah, it's a really important question, I think, particularly as we've seen the ETF industry evolve. And I'll go back to the investor, because really when we think about product development, we really take an investor first mindset. And what we heard from our clients is that they were looking for expanded choice from Capital Group. They wanted more ways to access our time-tested strategies to access the capital system. And so we chose to launch ETFs that would complement, not clone our American funds, because in the end, we believe that that's bringing greater choice to the market.
You know, Dave, in a world where many of these ETF fund groups are focused on the shiny objects you and I cover all the time, like thematic tech, Capital Group is doing something different. They're sort of sticking to this actively managed core strategy. What's your thoughts on that?
Yeah, I do think it is a differentiator here. A lot of the active management we've seen has been, as you put it, shiny objects, thematic tech, clean energy, things like that. This is really active at the core. And for a lot of advisors, this is something they're pretty comfortable with. What you were saying, Bob, I think is very interesting. You know, you can go out and buy Growth Fund of America as a mutual fund. Every financial advisor in the country can do that. It's on, practically half the 401k plans in the United States. However, these are different, right? They're interesting ETFs at the core. And, because they're ETFs that aren't direct clones, it means that it can take advantage of things like some of the tax loss, the tax lot management that ETFs can really benefit investors with. And it also means that they don't have to worry quite so much about liquidity issues. So I think there's a lot here for folks to grab onto. I think it's worth pointing out, too, that these are coming in pretty cheap, right? I mean, I think the weighted average expense ratio is a bit under around 40 basis points. That puts it in the bottom quintile of actively managed equity ETFs, right? 400 of the 500 active ETFs we have in the market right now that are tracking equities are over 50 basis points in fees.
Yeah, Holly, what about those different fees here? So I'm looking at the fees you're charging here for some of these. There's 6 of them, 33 to 54 basis points, it looks like, for these actively managed ETFs. But these are all lower fees than you're charging for the mutual funds that are out there. Are you at all concerned about that competition you're setting up with your own funds here? These are cheaper, as Dave points out.
Well, I think an interesting point is when we think about pricing our products in the market, we're focused on the competitive landscape. And as an organization, we have had a legacy of delivering very low-cost active management. We strive to be in the lowest quartile among peers with every product that we bring to market. And so with these ETFs, we will be priced in the lowest quartile and some even the lowest decile among competitors in this space. Our mutual funds and our ETFs are priced actually very similarly if you look at kind of common share classes here. So we don't believe there's a very big disparity here. And again, when I think about the ETF, it's about increasing choice for clients that prefer the vehicle. We think there's a place for both mutual funds and ETFs in our client portfolios.